Most people think investing is about picking the right asset, but the make or break moment is usually boring. It's the month your bills still show up and the market doesn't care. Welcome back to the Passive Transcript Dialogue. Transcript Dialogue. Today we're talking about a simple idea that sounds obvious, but changes everything. Before you invest, you need a plan for cash flow, and if the economy turns, you need a plan for what you do when you're stuck. I've invited a guest to help us unpack this. One note, the guest is a fictional character. No credentials, no fame, just a clear way of thinking. Thanks for being here.
Thanks for having me, and yes, I'm fictional, which is honestly a relief. No ego to protect. Let's keep this practical. We'll talk about what people call investing, what it actually is, and what tends to go wrong when the cycle shifts.
Let's start with the word investing. People say it like it's a personality trait. What do you mean by it?
I use a blunt definition. Investing is when you can explain in advance how you expect to get paid, what could go wrong, and what you'll do if it goes wrong. If you can't explain those three things, you're not investing. You might still make money, but it's closer to hoping than planning.
So the problem isn't risk, it's unplanned risk.
Exactly. Risk is part of the game, but the way most people experience risk is surprise. The surprise is what breaks them.
Okay, let's make this real. What does surprise look like in normal life?
It looks like a person who bought something because it was going up: stocks, crypto, a house, a fund, anything. They didn't buy a plan. They bought a story. The story was, this will keep going up and I'll look smart. Then the cycle shifts. Prices fall. The person feels trapped, not because the asset is evil, because their life depends on timing.
Timing, meaning they need to sell at the right moment.
Or they need the price to recover fast. Or they need their job to stay stable. Or they need interest rates not to change. They stacked a lot of needs on top of one decision.
And cash flow is the thing that removes those needs.
Cash flow buys time. And time is the real protection in investing.
You said something earlier that I want to underline. How you expect to get paid. Because most people only have one answer. Price goes up.
Yes. Price going up is not a payment. It's a possibility. Payment is rent, dividends, interest, business profit, royalties, a service contract. Payment is something that happens while you wait, without you needing to be a hero.
That's the tension, isn't it? People want investing to be exciting, but what works is unexciting.
Exactly. Real investing feels like watching grass grow. Speculation feels like fireworks, and humans are wired to chase fireworks.
Let's talk about why this matters more when recession fear shows up. What changes when the economy slows?
Two things happen at the same time. First, the easy returns disappear. In strong markets, people confuse the tide with skill. Second, personal pressure increases, layoffs, reduced hours, higher costs, tighter credit, so even if the asset is fine long-term, the person may be forced to sell at the worst time. That's not an investing failure, that's a cash flow failure.
I want to bring in a question people quietly have. If markets are risky, why do the richest people get richer anyway?
Because many of them don't live on wages. They own assets that other people pay into. And one of the biggest flows comes from systems that automatically invest money on behalf of workers. Retirement contributions, pensions, index funds, institutional portfolios. Every month, a portion of millions of paychecks becomes demand in financial markets. Over time, that steady demand supports asset prices.
So even if someone never buys a single share themselves, they may still be feeding the machine indirectly.
That's right. And I'm not saying that to make people angry. I'm saying it because it explains why just working harder often feels like running uphill. If you only earn wages, you're on the payroll side of the economy. If you own assets, you're on the ownership side. The passive path, as a philosophy, is basically move at least part of your life to the ownership side.
But there's a trap here. People hear ownership and immediately think buy something expensive, a house, a rental, a portfolio, and they skip the step that makes ownership survivable.
Yes, they skip the step called base. A base is stable income plus stable buffer. It's boring, but it prevents forced selling. Without a base, every investment becomes a stress test.
Let's use a story. Two families buy homes. Same city, same year. One panics in a downturn and sells. The other buys more. Why?
The simple answer is cash flow and flexibility. Let me paint it. Family A buys a home they can afford only if everything stays perfect. They're counting on steady jobs, stable rates, and no interruptions. When the economy turns, their income gets shaky. Their home payment doesn't care. They sell to stop the bleeding. They don't sell because they're weak. They sell because they ran out of runway.
And family B?
Family B thinks differently. They treat housing as a cash flow system, not a status symbol. They might live in a cheaper place and rent out a better asset, or they buy with enough margin that a rough year doesn't break them. They can negotiate refinance when possible, cut expenses, or temporarily lower returns. They have options.
Options are everything.
Exactly. Investing isn't about predicting the future perfectly. It's about having enough options that you don't need perfect predictions.
You also make a strong distinction. Investing versus buy low, sell high. Walk that line carefully for us.
Sure, buy low, sell high is a trading slogan. It can be a business, and some people do it well. But it's not the only meaning of investing. In everyday life, when people say I'm investing, they often mean I hope I can sell this later for more. That's speculation if you don't have a plan, and if you don't have staying power. Investing to me is about building assets that can survive time. Cash flow assets survive time better because they pay you to wait.
So if someone buys a house purely hoping the price rises, they may have a good outcome, but it's fragile.
Exactly. If the price rises, they feel smart. If it falls, they feel trapped. The same action can be investment for one person and gambling for another, depending on cash flow.
That sounds like a harsh statement, but I get it. The same move with different balance sheets is a different game.
Yes. Imagine two people, both buying the same stock. One person has a strong business that produces extra cash monthly. The other person is using their last savings. If the stock drops 30%, the first person can keep going. The second person might be forced out, emotionally or financially. Same stock, different outcome.
Let's talk about the temptation to average down. People love that idea. It dropped, so it's cheaper. I'll buy more.
Averaging down is a tool, but most people use it like a superstition. They treat cheaper than my purchase price as if it means safe. Price being lower doesn't tell you the decline is over. It also doesn't tell you your personal cash situation can survive. If you keep buying into a falling market without a plan, you're increasing exposure while the trend is against you.
And you can run out of ammo.
Exactly. That's the part people ignore. They say, I'll keep buying until it turns. But the market can stay irrational longer than your budget can stay patient.
You're pointing at something that sounds almost military, like strategy.
That's a good analogy. Strategy isn't bravery. Strategy is math plus discipline. In conflict, you don't win by wanting it more. You win by concentrating advantage. In investing, the advantage is usually capital, cash flow, and time. If someone can deploy more capital later, they can wait out volatility. If someone can't, they should not pretend they're playing the same game.
This connects to a classic gambling trap, the double it until you win strategy.
Yes, the martingale idea. On paper, if you have infinite money, you can keep doubling until you hit a win. And when you win, you recover losses and gain a tiny profit. But in real life, money isn't infinite. Tables have limits, and loss streaks happen. So the strategy works right up until it destroys you.
That sounds like how people act in market crashes. They keep buying because it has to bounce.
Exactly. Sometimes it does bounce, but sometimes is not a plan. The danger is that your downside grows exponentially while your upside stays modest. That's the hidden math.
I want to bring in the famous example people like to cite. Big investors buy when there's blood in the streets. People point to Warren Buffett in 2008. They say, see, buy the dip.
That example is real, but the lesson is often misunderstood. The lesson isn't be fearless. The lesson is have a cash machine behind you. If you have consistent income, especially business income, then deploying capital during panic can be rational, because you can survive being wrong longer. You can recover. If you don't have that, then copying the behavior is not investing. It's cosplay.
Cosplay is a strong word.
I mean, it gently. People copy the visible behavior. Buying during crashes, they don't copy the invisible structure. Massive cash flow, access to credit, and the psychological ability to wait. They try to perform the move without the foundation.
So the real question is not should I buy the dip? It's do I have the structure that makes dip buying survivable?
Exactly. If you don't, the better move is to build the structure first.
This takes us to a controversial point. Some people say, start investing even if you have no money. You push back on that.
I do. If you have no assets, what are you protecting? If you're one emergency away from panic, investing is not your first job. Your first job is stability, skills, income buffer, and then ownership. It's not anti-investing. It's sequencing.
Sequencing is the theme.
Yes. The passive path is a sequence. Step 1, stop bleeding. Get your spending under control. Step 2, build a buffer. Step 3, build an income engine that doesn't depend solely on your hours. Step 4, invest the surplus, not the survival money.
Let's get concrete. What does income engine mean to someone with a normal job?
It means building something that can pay you without constant direct effort. Not magic, just leverage. A small service business that becomes repeatable. A digital product. A content library, a set of skills you can sell at higher rates, something that shifts you from I get paid only when I show up, to I get paid because I own a system.
The transcript you're based on leans into YouTube as an example. Why YouTube specifically?
Because it's a low barrier ownership model. You can start with a phone and a clear idea. You build a library of content that can keep earning from ads, sponsorships, affiliates, or products. It's not instant, it's not guaranteed, but it has 3 features that matter. 1, it can run while you sleep, because old videos can still be watched. 2, it's resilient in downturns, because people keep consuming information and entertainment. 3, it builds an asset you own, your catalog, your audience, your skills.
And it fits the theme of cash flow. It's not just hope price goes up.
Right? It's build something that produces. Even if the market is ugly, views still happen. It's closer to a small business than to a lottery ticket.
I can hear a listener saying, but that's still work. How do you answer that without overselling?
YouTube is work up front. The passive part comes later. If you build a catalog, it's like planting trees. Planting is labor. Shade is passive. And the point isn't that everyone must do YouTube. The point is build an engine that can keep paying you during unstable periods.
Because that engine becomes your reinforcements.
Exactly. It's the difference between being forced to retreat and choosing your timing.
Let's switch to recession indicators for a moment. The transcript mentions watching long-term treasury yields and the dollar index. Why those?
These are proxy signals for fear and liquidity. When large institutions rush into government bonds, yields can fall because bond prices rise. That often reflects a risk-off shift, and the dollar index often rises during global stress because dollars are treated as a safe haven. These aren't perfect predictors, but they can be useful as weather reports.
Weather reports, not a prophecy.
Exactly. A weather report doesn't tell you the exact minute it will rain. It tells you whether carrying an umbrella is wise. When those signals move sharply, it can be a reminder to check your exposure. Not to panic, to plan.
Planning is the quiet superpower.
Yes, most people think the rich have better predictions. Often they just have better preparation. They hold assets that pay them. They hold reserves. They can act when others are forced to react.
I want to anchor this in one definition you used. Your real asset isn't the cash you have. It's how long you can live without working.
That's my favorite definition because it's brutally honest. If you lost your job tomorrow, how many months could you keep your life stable? That number is a real measurement of financial strength. It's not your net worth screenshot. It's your runway.
That's uncomfortable.
It is. But it's also empowering because you can improve it. Increase income, reduce fixed costs, build a buffer, add cash flow. You don't need to predict the market to do those things.
Let's talk about the mindset shift from employee to owner, not as a motivational slogan, as a practical move.
Practically, it means separating two questions. Question 1, how do I earn money this month? Question 2, how do I build something that earns without my presence? Employees are usually trapped in question 1. Owners spend time on question 2. You can be both. The goal is not quitting your job tomorrow. The goal is building a second leg under the table.
Second leg.
Yes. If your whole table is one leg, any wobble is a crisis. Add another leg, side income, a small asset, a catalog, a rental, a service, and the wobble becomes manageable.
A listener might say, okay, but I still want to invest. What's a sane starting point?
Start with a plan, not with an asset. Write down how much can you invest monthly without touching your emergency fund. What's your time horizon? What would make you sell? What would make you buy more? How much volatility can you stomach without losing sleep? If you can't answer those, your first investment is learning and stabilizing cash flow.
And if you can answer them?
Then you choose assets that match your answers, not someone else's answers. That's where people go wrong. They copy an asset from someone with a different life.
Different life, different game.
Exactly. A person with stable surplus can hold through drawdowns. A person with fragile cash flow needs simpler, safer decisions. There's no shame in that. It's just reality.
I want to revisit the earlier distinction. Investing versus gambling. Can you give a simple checklist?
Sure. If you're buying because everyone is talking about it, that's a warning. If your plan is I'll sell when it feels scary, that's a warning. If you don't know your downside, that's a warning. If you're using money you can't afford to lock up, that's a warning. Investing is calm. Gambling feels urgent.
Calm versus urgent.
Yes. Urgency is the emotion that gets you trapped. Calm is the emotion that lets you execute.
Let's land this with practical takeaways. If someone is watching this and thinking, I'm late, I'm behind, what do you want them to do this week?
3 things. First, calculate your runway. How many months could you live if income stopped? Second, identify one cash flow improvement you can do in 30 days. Raise income, cut a fixed expense, or add a small side stream. Third, draft an investing plan on 1 page. Not fancy, just rules you can follow when emotions show up. If you do those 3, you're already ahead of the person who only collects stock tips.
I'll summarize in my words. Investing isn't a vibe, it's structure. Cash flow buys time, time prevents forced mistakes, and the best market prediction is building a life that doesn't break when the market surprises you.
That's it. And I'll add one last gentle reminder. A recession is not only a market event, it's a personal cash flow event, so your first job is to become hard to knock over.
That's a very passive path ending. Build the base, build the engine, invest the surplus. Thanks for joining us.
Thanks for listening. Goodbye. And done.